Hello students, now we are going to practice how to make a performance evaluation. This performance evaluation is a part of the management control system, starting from the set up the goals with the targets and make a plan and executions, and we measure the plan with the actual, which is variance report, and then we have to evaluate the performance. Giving some reward, the right feedback to the right person. So the responsibility accounting provides perspective on how a management control system report can stress cost behavior and controllability of manager performance and responsibility center performance simultaneously. So we have a very, very interesting the exercise table, as you can see that. The following table indicates a retail grocery store income statement by company as a whole, and company breakdown into two divisions. And then the West division, we are going to focus on this West division. Maybe you can understand why we need to break down this the West division into the specific product lines, which is department, because the West division has some issue. And then we also found out the mid department has some more problem than the other department. So we will identify which stores has more problem or which store did a really good job, and then we can give some incentive to one of the stores or one of these product lines or one of these the divisions. Okay. As you can see that the contribution margin or contribution controllable by segment measures and contribution. So the contribution is one of the measure of performance. The reason why we segregate this fixed cost with controllable and not controllable or controlled by other managers is that we want to give the specific, the right, the feedback to the managers who has the responsibility on this result. Okay, so let's go. This company as a whole, 4 million, whatever. Okay, the $4,000 and less the variable cost. Merchandise and variable cost over operating cost 260. The variable operating cost, for example, wages or payroll related cost. So the contribution margin, how to get it? Right, we just, okay, let me just simply add 4,000 and total variable cost is contribution margin. And then how to get the contribution margin percentage? Contribution margin percentage can be calculated, right? This contribution margin over net sale. So 18%, 5%, 18.5% is contribution margin. And then out of a total fixed cost, 260 and 460, only 260 is controllable by segment managers. So this controllable fixed cost, for example, the advertising or sales promotions and salesperson's salaries, management consulting fees, or training and supervision costs, those are the fixed costs controllable by segment managers. You may remember that is the discretionary cost that the segment managers can control. But this fixed cost controllable by others, $200, for example, depreciation, the property taxes, insurance, perhaps the segment manager's salary, those are not controllable costs, which is committed cost. So we want to segregate these two different types of cost in the fixed cost so that we can give the right feedback to the segment managers who has the responsibility on it. Okay. So this contribution margin plus this minus the fixed cost, 450. So let's calculate one more time contribution margin out of total sales. So 12%. Okay, so 12% is profit margin, contribution profit margin, controllable by segment manager with $480. And then after this, we also want to get this, the fixed cost control, the contribution by segment, including all the responsibility, cost responsibility by segment managers or by others. So 280. So we want to see the percentage as well, contribution margin percentage as well. So 7%. The profit margin, including all the fixed cost and the variable cost, is 7%. Now, we want to break down this company contribution margin, contribution controlled by segment managers and contribution by segment into two divisions. Okay, we have the East division and the West division. So let me just drag to the right. And then, as you can see that we have a result. We have a result of $300 in the East division and $440,000 West division. East division has lower net sales, West division higher one, but yeah, definitely the variable cost in West division is higher than East division, but contribution margin is higher, but the contribution margin percentage is lower. That means that if they have the same net sales, this East division would have more contribution margin. In effect, so we need to focus on this less contribution margin percentage, and then fix the cost controllable by segment managers. And then I'm going to just drag it to the right. Then, as you can see, that still 280 after the subtraction of the fixed cost controlled by segment manager, 280. So we want to know the responsibility of the segment managers of the result by the number, by the effect. This 280, that West division is higher. But what about this the margin percentage? The percentage margin is lower, only 11.2%, which is lower than the East division. Okay, so if we want to compare these two segment managers, then we can give the more praise and reward to the East division in terms of this efficiency, in terms of profitability. Profitability. But the West division is a little bit lower, even though they make more contribution. And then contribution by segment, now 90,000 and 110,000, which is the fixed cost controlled by others that is not related to segment managers. So we can calculate in the same way. So 170, but when you calculate the profit margin, profitability, so which is lower, right? Still, the West division is lower. So we want to identify where went wrong. So let's go to the West division breakdown. So West division breakdown into three product lines, three departments: grocery department, produce department, and the meats department. They have their own the net sales and the variable cost as well. And then there's no not allocated. So we are going to calculate in the same way. So $260,000 and $180,000 is contribution margin of each department. And then contribution margin, now we got, here is not necessary to show. The West division has the grocery and produce the meats department that has 20%, 20%, or 15%. Oh, the grocery store contribution margin is 15.38%. So a little bit lower than other departments. But when we try to identify which segment manager has a responsibility, then now let's calculate it. The grocery department, this fixed cost control over by segment manager is very low, very low. So as you can see that the contribution controlled by segment managers in grocery store is highest. But we want to also know that what is the profitability. Profitability, you can see that the produce department has 16%, very high, 16%. The overall in West Division was 11.2%, but 16.67%, which is high, and 12.31% in grocery store, which is definitely higher than this overall West Division profit margin percentage by segment managers. So we can evaluate that the segment managers as lowest profitability. So we have to focus on this number, okay? And then the rest amount is the fixed cost, which is not controllable by segment manager, but controlled by other managers. So let's calculate it in the same way. So we can see that the contribution profit margin percentage by segment in produce department is highest, and then grocery is highest, which is higher than the West Division, but this 5.56% are very low. The profit margin by segment that has some responsibility for the lower the West Division profit margin by segment than the East Division. Okay, then we also can break down this meats department into the two stores. This meats department has two stores that make 600 net sales and 300 net sales in stores. So we want to see that which stores has a problem. Okay. Then we found, the store 1, the contribution margin is a little bit lower than the store 2, but it's not the significant material the differences. Now let's evaluate this segment managers. The segment managers in store 1 made 880, which is higher than the store $40,000. But in terms of the profitability, it's the exactly same. So when we evaluate these segment managers, there's no differences. So this 13% and 13%, except for this not allocated. Not allocated cost is the cost not clearly or practically allocable to any segment. So after the removing this 30, now we see this 13%, 30% exactly identical. So we cannot give any the responsibility of lower the profit margin by segment managers into the specific store. And then contribution by the segment in terms of the profitability as well. The store 1 is a little bit lower, but it's not because of these segment managers, but because of this higher the fixed cost controlled by others, like depreciation or property taxes or the insurance and some management salaries. Okay, that is the way to analyze and evaluate each divisions or departments and some the stores in order to measure the performance by segment managers or by others or by just total segments. Okay? Yeah, that's all. See you in the next video clip. Bye-bye.